The Fed decision is in. What does that mean for the second half of the year? I'm Michael Smith. Welcome to the Lowdown. Everybody, I'm Michael Smith. Welcome to the Lowdown, and joining me today, Kevin Lennox, back on the show. Well, welcome back for one. We've had a pretty interesting month. I think a lot of the things that we talked about last month have started to come to fruition, and we'll get your thoughts on that. But I always like to maybe start, you talk about business cycles, and I think maybe for our audience, maybe where are we on a global scale? Where are we? Kind of that little chart says you are here. Where exactly are we in a business cycle?
Mike, I've been a business cycle investor for over 20 years, and it's a very important part of the overall asset allocation process and also communicating with clients. And the chart here is from Fidelity. It's an easy search to find it, and it's a fairly representative view with most firms as far as where we are in the cycle. And you can see here that the bubbles are focused most heavily on the right side. And you see the little mountain in the background, and we're clearly on the downside. And I'll often show clients this chart, put my pen right in the middle of it, and just say, when you're on the right half of the business cycle, then the risks are higher that we could see downward movement in the market, slow down the economy, possibly recession. And therefore you should be a little more defensive in your allocations. So when the bubbles are all stacked over to the right, as you know, for a couple of years now, really since the third quarter 2021, I've been of the view that we've been in the late stage of the business cycle. And that means higher quality type stocks, more large company stocks. And on the equity side, those have been the best performers despite all the volatility. So you adjust your risk profile and asset class preferences based on where you are in the cycle. Question now is, do we go into full-blown recession, or have we already sort of been there? The market is now up 20% off of the October lows. Some are saying we're in a new cycle now.
Well, and so it's interesting, you talk about the 20%, bump that we've seen here. And if you kind of look through the quality of that, what's kind of shocking is the breadth has just been very minimal, right? You got 480 stocks somewhat flat, 20% really driving. So we call that kind of a low breath rally. Not determining if this is a bear market rally or bull market rally, but I think all that's going to depend. Here we are at the halfway point. We know we got the big Fed meeting today, so what their decision's going to be. And then yesterday came out CPI, and that's what my next question for you is 4%, and a huge decline from where we were right at the peak of the pandemic and the inflation. Not at the Fed's target of 2%, but maybe give me your thoughts on what did you like about yesterday's CPI, and maybe what are some things that kind of concern you about the number itself?
So the disinflationary trend, at least at the headline level, is coming down nicely. We peaked last June just over 9%, and now we've got a headline year over year at 4%, as you mentioned. So the concern is this sticky inflation. People keep looking at the core, and that number came out at 5.3% year over year. Now, a lot of us analysts will look at the last 3 months annualized. Well, that's at 5%. So it's still sticky. And just a year ago, the 3-month was 5.8%. So the stickiness in the core is what has the Fed's attention at this point. And the hope is that it doesn't spread from there, but instead just slowly declines over time. Which will allow the Fed then to stay on hold.
Sure. Well, I read today actually, and you and I have talked about this, and maybe something to kind of mention is how arcane some of the data and the way that CPI is put together. For instance, owner's equivalent rent makes up about 30%. Those are highly lagging indicators in that CPI data. I read actually an article today that if you use the Case-Shiller price, the home price, right? If you replaced the owner's equivalent with that, and then if you take out, I think it's the Mayhem used car price, that we might actually be at 2% if you had changed those indicators. So just kind of curious your thought on the current measure, how that's being measured, and just kind of what's your thoughts on what we're using as a tool?
Mike, I want to show you this chart that I think takes some of the noise out of the CPI. We've talked before about all the games played and hedonics and all of that. The monthly ISM PMI report. It's a monthly survey among service companies, and it tends to give a less noisy look at inflation and actually typically leads the CPI by several months. So this chart is an overlay of the ISM services price component side the CPI index. So I think it's a little more stable and reliable index to look at rather than just CPI in isolation.
Yeah, well, I mean, good thing commodities have come down to some degree. So now let's kind of maybe pivot because, we got the Fed meeting, right? Probably one of the, I think it's a big meeting because I think 90% right now expect a pause. But what do you think, what are your kind of thoughts on the Fed? What should they do? What do you think they're going to do?
So we talked about this last month, and we talked about, the Fed should pause here. There is a long and variable lag as far as the impact of changes in interest rates by the Fed, and anywhere from 6 to 18 months. So because of the softer CPI print, I think it gives them the latitude to pause today and potentially through the rest of the year. But I would expect Jay Powell and the presser to have something of a hawkish tilt.
Okay.
Not to imply that they are done with rate hikes for the rest of the year. Go back to being data dependent. We will see, but we're happy with the trend that we see developing now. But the long and variable lags still have to work their way through the system, so we'll wait and see. But for now, this is just a pause, and we reserve the right to increase rates later on in the year.
Leave it very open. I mean, do you think that they will actually, because one of the things they pigeonhole themselves is that 2%, right? They kept saying, we're going to get back to 2. Do you think we start seeing some softening or maybe some backing off, or do they come out and say, hey, maybe today we need to rethink that 2% target? That would be smart, in my opinion, if they did it, but do you think they will actually do it?
They can't.
Really?
They've had that 2% line in the sand forever, and they can't, at least at this point, go back on it. I think in 2 to 3 years, they're going to be forced to accept a higher level than 2%. But they can't communicate that now in any form or fashion.
So they'll probably just avoid that in general.
They can hide behind the long and variable lags probably for another year.
Yeah. Okay. Well, in Fed speak, that's a long time. So, and it keeps you from putting your foot in the mouth, which we know Jay Powell has done quite a few times. Well, let's maybe talk about, since we're at that pivotal point, and this is always where, okay, what do the markets do, right? So maybe kind of talk me through, what do you think are some of the bullish cases? I mean, I know recently CEO confidence indicator is up. You got NFIB, a small business confidence is also up. I think a lot of them just anticipate, hey, we're almost to this end of this tightening cycle, so I think that might be the reason. But maybe lay out your bullish case, and then maybe what could be a bearish case for the markets between now and the end of the year.
So I'll start with the breadth. When we met just about a month ago, really all the leading indicators were pointed south. And since then, almost immediately after that show, then things started turning more positive, which happens in the late stage of the business cycle, pre-recession or early stage. There's a lack of consensus. And myself and many other portfolio managers, we talk and we're like, if you have a narrative, you can find the data to support it.
Yeah.
And look very convincingly. And so we force ourselves to talk to other people, look at other data that don't think the same way that we did.
Absolutely.
But the narrow breadth, which had been really a focal point for several months, 7 stocks, 8 stocks were driving almost all, like 95% of the gain in the S&P 500. Like, well, bad breath. Then that means it's a weak market, likely to fall over. But actually, when you look back over time, the modern era, when we've had narrow breadth, more often than not, breadth has subsequently broadened.
Okay.
And we started to see the cyclical stocks reassume the leadership over defensive stocks that was going from the very beginning of the year through February up to the bank shock.
Okay.
And now we're seeing the cyclical start to move higher again, relative to defensives. Small cap stocks have improved as well, just about the same time. Retail stocks now finding a bid. So all of a sudden now the narrative is being shaped around the soft landing scenario.
So it's
Now,
broadening
if
out.
the Fed is on hold, if corporate earnings continue to surprise to the upside, then, and we've recently seen revisions higher
Sure.
for the S&P, then people say, with the Fed on hold, better fundamentals, as long as we get improved growth without another higher leg in inflation, there's room for earnings estimates to move higher
Absolutely.
and this market to go higher. And with respect to valuations, if you just take out those big tech stocks, the PE ratio for the S&P 500 is right at the 10-year average.
Okay.
So not as elevated as
Yeah.
some have said. That's the bullish case.
That's the bullish case. Okay. All right. So, and a lot of that makes sense, and I agree with you. If the Fed does come out and say, look, we reserve the right to change or review the data, but we're going to hold, but they're not saying we're going to stop and no more, they're not going to do that, then I think that probably lays pretty nicely into that bullish case. But let's talk about the bearish case.
The bearish side is, as we harped on more last time,
Yeah.
is we saw cyclical sharply underperforming. Credit spreads, financial conditions had tightened pretty sharply. We had just gotten the senior loan officer opinion survey, which is a survey done by the Fed on a quarterly basis among all the big commercial banks. And the headline was that they plan to tighten lending standards across all channels, from businesses to household mortgages, for the remainder of the year. And the weakness in the banking channel, as we discussed quite a bit last time, then just puts a lid on the accessibility of capital. And that credit which is available is done so at a higher cost. And that really strains the lower income households, really strains small businesses, and more particularly when small businesses get stressed, then it's a matter of time before they have to do layoffs.
Yep.
And those are the larger employers in aggregate than versus big business. And then you start to see a big uptick in the initial claims. All of a sudden the sentiment could change again. So if financial condition lending standards stay tight and we wean off this excess savings, then there's vulnerability in the market, which is not to be understated,
So
which is
potential
again why we
defaults.
rely on the business cycle. So, our thesis has been hold quality large cap companies, and part of success is investing. And we've talked about this before. How long can you stay long?
Exactly.
In other words, without panicking.
Yeah.
I know some high profile people and fellow portfolio managers that over the last few months went heavily to cash or cut
Yes.
their equity holdings for clients by 50% or more.
And now they got the
That's
fear of missing out. The FOMO effect has been happening.
So part of this rally now
Yeah.
is FOMO.
Yep.
Oh no, I missed it.
Yeah. Yes. Yeah,
Now I got to
absolutely.
get back in, and then the momentum is short covering.
Yes.
So we've got this piling on right now that's all favorable, and we'll see how this.
Well, like I said, anything can really tilt that bullish and bearish case. I was going to ask you this. I mean, if you looked and you had showed us a chart that the household cash levels are, at 40%. I mean, this is kind of levels we saw during the pandemic. If I look at that, is that telling me that the consumers, I mean, we've seen recession to 2000, 2008. We saw during the pandemic. I mean, we've been through this before. I mean, our consumers now, because it's been probably the most advertised recession coming, right? So you think consumers are just positioned well ahead of that? And that kind of ties into what you just said. A lot of people that fear missing out were holding cash. Is that what that's reflecting, or what else does that tell us?
I didn't really see that people were selling assets and putting money in their checking and savings account. It's just that the buffer of all that cash infusion from COVID,
Okay.
that stimulus money just hasn't been exhausted yet. And from recent studies, cash balances are much higher than previously thought. And so therefore, we've talked about it on several shows now, we're not seeing people do things differently.
Yeah.
Outside of that, everything sort of looks normal. So it's a two-speed economy.
Yeah.
But that, with cash levels 40% higher than 2019 levels, that's why I think we're still seeing the airports, restaurants, hotels all full. We haven't gotten to that point yet, and consumers are leveraged spenders. They will
Yes.
continue to spend until they lose their job.
Yeah.
And we haven't seen
not at
that
that
big
part yet.
uptick in unemployment, and it probably takes that to make the sticky inflation really get down anywhere close to 2%. So we'll see if the Fed can pull off this immaculate disinflation.
Well, and so remember, even if they pause, I mean, the lag effects of the previous rate increases, those still have to work their way in. 6 to 9 months is what we often say. So, I mean, again, I think it makes sense to watch that. So that means things could get worse. The financial conditions could get worse. Credit could get harder, and of course, maybe that cash buffer you're talking about kind of dwindles away. So we'll see. I mean, it's gonna be. I think next month's gonna be a very important, meeting for the Fed. So we'll be definitely updated on that. But what is the one thing? I mean, look, none of us have a crystal ball. I think trying to make big calls or make big pivots, are very dangerous. But Kevin, one of the things I think we do, and we talk about all the time, is making investment decisions, but financial plan-based investment decisions, using a good financial plan to show you how you should be allocated. That's probably one of the best ways to kind of avoid being stuck in this. Do you go to cash? Because I'm sure people right now are thinking, well, do I just go raise cash all summer? Or do I pile in? Or, as you mentioned, some people have been trying to figure out, well, to just avoid all that, which is clunky. And by the way, many people will not be successful doing that. Trying to time the markets. You've been in this business a long time, so I have never seen anyone successfully do it. They may have gotten lucky once or twice, but their luck ran out. So I don't know what your thoughts are, but just kind of maybe elaborate on plans that you use, or making sure people get their plans updated.
Yeah, so I have CFA designation as well as CFP. I will tell you what's most helpful for clients as far as the communication process is using my CFP background to walk through a detailed financial plan with a client, help them understand where they are, tie that then to what their goals are, and just see the level of strength within their financial plan. And most clients we work with, have a decent asset base to where they shouldn't be concerned about near short-term gyrations in the marketplace, or oh my gosh, should I cancel my summer vacation and all that. So it provides a lot of calmness, I think, in the client relationship, so they're less inclined to say, I've seen enough, take me to cash, or cut my equity by 50%. So I think it's a very important part of the process. And I go through the financial plan, and then the very next thing when we start talking about asset allocation is I show them the business cycle. I think it's important to show the connection between the financial plan, their goals, the asset allocation, and how that ties to the market outlook. And so, here, we're big proponents of core satellite portfolios, where the majority of the portfolio is all in low-cost ETFs, not making any asset allocation bets with that. So you're connected to the market. But then tactically, we say, well, based on where we are in the cycle, we should overweight or underweight these few asset classes. And when you're in the very late stage of the business cycle on the edge of recession, then you take fewer tactical bets. So as we've said ad nauseum, high quality blue chip stocks, they have the strongest balance sheets, the most market share, most ability to raise funds at a very attractive rate, can buy back their shares, increase their dividends. It's a huge advantage, and that means a lot at this stage of the business cycle. So as you know, we have a money manager, a couple that we use to really focus in on that, and that's handily outperformed just because know where you are in the cycle. Now, when we get to the early stage of the business cycle,
it's going to be much different.
They will underperform sharply, so that's part of it. But I've held this strategy.
And when you confer that we're out of the recession, then that's when you load the risk back up.
Yeah, so we didn't take huge bets at all.
Exactly.
But we've done really well over the last couple of years just by having a few tactical tilts that are really just predicated on where we are in the cycle. So I think that's important. The communication process, and as you know, I always have a lot of charts that I show to clients to help them understand. Many are engineer types, but that's very important to cover that.
Well, in summary, we started the show where we were in the business cycle, entering a recession. We still don't know if that's going to be a hard or soft landing. But I'll tell you what, if you want to navigate that well, that's why we advocate having a financial plan, making sure that's updated. That'll help you kind of relax and go enjoy your summer. For those that don't have it, well, may not be so enjoyable. But you know what, Kevin, thanks for joining me as always. I can't wait to see you next month because I think it's going to be a very important month for us to really discuss. But we'll be seeing you here. Thanks, Kevin.